In today's lesson, we are going to look at the principles and practice of double entry. I said the principles and practice of double entry. I want to emphasize that accounting is a subject that if anybody wants to take a course in accounting, must sit back to understand this principle, because this is the foundation of accounting, the foundation on which every other transactions or practice around accounting is built. If you want to go into accounting and you don't take some time to look at the double entry principle, accounting will become a very difficult discipline for you. I think this is why students have been complaining. They say accounting is boring, accounting is uninteresting, because they don't understand the double entry principle. And this is one of the reasons why today in this lesson we are going to take our time to explain the double entry principle and how students can apply this principle in attending to accounting related questions. Let's look at what we serve as our objective. There are things that will guide our interactions in today's lesson. Number one, we will see how we're able to explain the rules of double entry. Number two, we will see how we can describe the procedures of double entry. Number three, we'll give a summary of a debit and a credit entry. And then number four, we will apply the double entry principle. Now, once we have done this, there is need for us to measure our level of success. So at the end of the lesson, we want to find out if we've been able to explain the rules of double entry, we've been able to describe the procedures of double entry, and we'll be able to give a summary of a debit and a credit entry, and finally apply the double entry principles on every transaction. Now let's make progress. What do we mean by double entry principle or double entry bookkeeping? I said the double entry principle states that for every debit entry, there must be a corresponding credit entry, and vice versa. What I mean by vice versa is that in another way, you can also say for every credit entry, there must be a corresponding debit entry. Now, I'm going to leave the principle here, and then as we make progress in the lesson, I will take some time to explain what I mean by debit entry and credit entry. But I want you to understand the fact that this principle is talking about a debit entry and it's talking about a credit entry. He's saying that for every time you have a debit entry, don't forget that there will be need for you to have a corresponding credit entry. Now, the second thing I want to point out is that double entry principle is the foundation of bookkeeping. The foundation of bookkeeping. What do I mean by bookkeeping? Bookkeeping is simply the systematic recording of transactions on daily basis in the appropriate books. The systematic recording of transactions on daily basis in the appropriate books. Every transaction have a particular book where the transaction is expected to be recorded. If you are into sales or purchase, if you go to the market to buy, maybe if you are buying on credit, there is a book that is expected to take care of that transaction. If you sell on credit, there's also a book that is responsible for that, or that is used for that transaction. So each of these transactions have their various books. So the process that is involved in recording the transactions in the appropriate books on daily basis is what we call bookkeeping. Now, I will not forget to remind you that until these transactions are recorded in the appropriate books, you are not a good bookkeeper. And then double entry principle is that principle that will help and guide the bookkeeper to record these books, to record these transactions in the appropriate books. Now, let us look at the summary of this principle. It said you should do what? Debit the receiver and then credit the giver. What do I mean by receiver and then the giver? Now, every transaction comes with just two parties. In every transaction, we have just two persons. We call it exchange. One must be on the giving end, and then another must be on the what? Receiving end. So the relationship that transpired between these two persons, where one person gives out something for him to receive something in return, is what we call exchange. So this exchange will take place between two parties. One must be on the giving end, while another person must be on the receiving end. So I simply define exchange as give me what you have to take what you want, and I will give you what I have to take what I want. So I will give out what I have to get what I want, and then you will give me what you have to take what you want. So when this happens, the principle recommend that debit who receive, and what? Credit who gives. That's just the principle. So it is this principle that will now determine what we have said earlier, that for every debit entry, there must be a corresponding credit entry. Because as you are debiting who is receiving, you are expected to also credit who is what? Giving. Now, let's look at the procedures. I said the procedures of double entry principle include the following. Number one, the keeping of the books of account. You see, the book there comes with an S. Books of account. That means there are different books that can actually be prepared under this principle. For every transaction, they have unique book. Like I said before, sales have his own book, purchase have his own book, returns have his own book, and cash have it. All these transactions have their various books. So first of all, there must be the keeping of what? Books of account. Secondly, each of these book of account is separated into what? Each of these books is separated into what? Accounts. What do I mean by separation into account? Now, let's just draw something on the board. Let's take it paid. Let's look at this transaction. Paid cash. Paid cash. Or let's say bought goods. Bought goods worth 1,000 naira cash. This is a transaction. Bought goods worth 1,000 naira cash. This is a transaction. Now, looking at this transaction, two persons are involved. I have said it earlier that two persons are what? Involved. The first person is what we call purchase, and the second person is what we call what? Cash. Why do we call here purchase? We call it purchase because the particular goods that is bought here is not specified. So we just categorize this to be what? Purchase. So the two accounts involved here, they are what? Purchase and the word cash. Now, between these two accounts, one person is giving and one person is what? Receiving. If you look at purchase and if you look at cash, once you go to the market to buy, something will do what? Will come into the company. So purchase is always on the receiving side. Because when you go to the market to buy, that item you have gone to the market to buy is coming to increase the value you have in the company. Meanwhile, if you are going to pay, if you are paying for the purchase, cash is given out. So this guy, Mr. Purchase, is always the giver. He is the what? He is the receiver rather. Purchase is always the what? The receiver, while cash is what? The giver. So let's look at what we have said so far. We said you divide each book into what? Account. So if you want to apply the principle here, you have your purchase account. Purchase account. This is what I mean. And then you have your cash. Let's write our cash. You have your purchase account. And then you have your what? Cash. Cash account. You can see now, purchase is divided into two with a capital letter T. This is what we call T method. This T method has divided this into two. First of all, I said it must be divided, the transactions, I said division of each book into what? Separate account. This is an account and this is an account. We have separated into two accounts. Now, each of the account is divided into two halves. You can see purchase is divided into two and cash is divided into two. This is the debit side and this is the credit side. This is the debit side and this is the credit side. You put your naira sign here, put your naira sign here. If we want to post that transaction into this account, because purchase is receiving and we have said debit the receiver, you come here and you write cash and then you write the amount 1,000 and then you come to the cash because cash is given. You write purchase and then you write 1,000. This is, you have completed the double entry principle. But I don't want to major on this for now. As we make progress in the lesson, we will understand. By the time you get to the level where we begin to apply the principle, you will appreciate the illustration I have done on the board so far. Let's look at the summary of a debit and a credit entry. Anytime you hear of the word debit entry, it connotes three different scenarios. Number one, an increase in the value of asset. If you go to the market to buy an item that qualifies as an asset into the company, because the asset has increased, an asset will always have a debit entry. This is against credit entry. When there is a reduction in your asset, then it will give you a credit entry. So we put it like this. An increase in asset, we have a debit entry, while decrease in asset will give you a credit entry. Please, students should take time. You should take time to understand this so they can memorize this when the need arises. Now, a debit entry is always an increase in assets, while a credit entry is a decrease in asset. The second thing is that the decrease in the amount of liability will give you a debit entry. We have explained what asset is, what liability is, and all that in our previous videos. We recommend that students go back to look at those topics and appreciate what an asset is and what a liability is. But for the sake of reference, let us look at a liability is just the claim of outsiders over the business. So when there is a decrease in that debt that the company is expected to pay, it will give you a debit entry. While when there is an increase in the liability or the claim of outsiders over the business is what? A credit entry. And then the last but not the least is an item of expenditure or expense. Expenditure or expense is simply the cost incurred in carrying out the business. When we have incurred maybe a cost, you incurred an expense, it will give you a debit entry, and then when you are able to get gain, or when you are able to earn a gain or an income, it will give you a credit entry. Now let's now go to the application. This is where I really want us to pay undivided or keen attention. We want to look at how we'll be able to apply the double entry principle. Now, we are going to use our board again to critically explain, because I want students not to find it difficult again to apply the principle of double entry. I want to promise you that your A is very sure in this particular topic if you can appreciate how to apply the double entry principle. A lot of times you see students complain, I don't understand this. You may not be able to understand how to post transactions until you appreciate the place of double entry. Double entry is a bedrock, the foundation of bookkeeping. I've said that earlier. So now, I said how to apply the rules. Number one, in every transaction, you do what? Identify the two accounts involved in the transaction. Number two, state the receiving and the giving account. Number three, note the effect of the transaction on each account. And then number four, take the required action. Debit the receiver and credit the giver. Let us look at one simple transaction that will drive the message home. Now, let me say that pay 2nd of May 2022 paid salaries 500 naira cash. And then 4th of June 2022, bought goods worth 1,000 naira cash. Let's take another one. And then let's say 8th of July 2022, what happened? Sold goods 40,000 naira what? Cash. All right. These are transactions. You can see now, number 1, paid salaries 500 naira cash. Number 2, bought goods worth 1,000 naira cash. Number 3, sold goods 40,000 cash. Let's start with number 1. What is the principle? We said number 1, identify the two accounts. Now, when you talk about paid salaries 500 naira cash, ask yourself, what are the two accounts involved? Number 1, what are the two accounts involved? They are what? Salaries and what? Cash. The two accounts involved are what? Salaries and cash. So number 1, the first one, identify the two accounts. So the two accounts involved are what? Salaries and what? Cash. Number 2, what we say number 2, state the receiving and the giving account. You state the receiving and the what? Giving account. Look at salaries and look at cash. I have said before that whenever cash is involved, as far as cash is involved, when there is need for you to get something into the company, you are paying for an obligation or you are buying an item, cash is always on the giving side. So if you look at these salaries, this salary now, probably this is what you're supposed to pay to workers. So because cash is used to make such payment, we said you should state the receiving. You know that salary is the one receiving. So you said the receiver is what? Salary. So salary is the one receiving. He said salaries, the receiver is salaries, while the giver is what? Cash. Is cash. Number 3, we said that you should note the effect of the transaction on each account. You should note the effect of each transactions. Now, when you pay salary, what happened? When you pay salary with cash, how does this transaction, how does it affect the organization? How does it affect the organization? First of all, you know that once you pay cash will reduce the cash you have. That means your asset is affected. Your asset is affected because you are paying this. And then because salary is a liability, salary is something that you are supposed to pay, your liability is also what? Affected. If you are expected to pay salaries at the end of the month, let's assume you are supposed to pay 50,000 naira salaries at the end of the month, and at the end of the month you have not paid, that salary is something that you ought to have paid. So it's a liability to the company. So the effect is that salary will do what? Because you have paid this salary, cash is given to decrease, while salaries will do what? Increase. So once you pay that money, the salary is already increasing. You have increased your salary, because if what you have paid before, you have paid 100,000 as salary before, and you have not paid 50, by the time you pay that 50 will be added to the 100 to give you 150 that you have paid for salary. So the effect is that there will be an increase in salary and there will be a decrease in what? Cash. The effect is that there will be an increase in salary and there will be a decrease in cash. If what we are having 100,000 and you remove 50,000 to pay cash, to pay salary, the money you have has reduced to what? 50,000. And then the fourth one is that you should do what? Take the required action. The required action is to debit the receiver and credit the giver. So look at what you have done. You have identified the two accounts as salary and cash. You have said that the receiver is salary and then the giver is cash. Then you have also identified, or you have noted the effect. You have said that is salary increase and then there is a decrease in cash. So the action required is debit the what? The receiver. Who is the receiver? The receiver is salary. Debit salary and the what? Credit cash. You debit salary and do what? Credit cash. You have completed the double entry principle. Having done this, your double entry principle has been completed. But students don't understand the process and the procedures involved. You have first of all identify the two accounts, know the receiver and the giver, note the effect of the transaction, and then take the action. Now, if I want to represent this on an account, let me assume I want to represent, I say debit salary and credit cash. You simply come here, you write your salary account, you rule your line. This is your credit side, this is your debit side. You put your naira sign, and then you come under it, you write your cash account. The same process, credit and the what? Debit. This is a naira sign. So what did I say? I said you should debit salary and credit what? Cash. So you come here and write cash, write the date. The date is what? 2nd of May, 2022. Then you write cash, you write the amount. The amount is what? The amount is 500. And then you come under cash, you credit cash, write the date is what? 2nd May 2022, and then you write salary, and then you write 500. Now, I want to explain something before we go to the next transaction. If you look at this, you will see that there is something that connects salary account and cash account. What is that thing? Look at it critically. Did you see that in salary account we have cash as the particulars, and then in cash account we have salaries? So in the ledger, whenever you are now preparing this in the ledger, it will be very obvious to anybody that is looking at it. This is the books of account that you have kept, and you have divided it into two. This cash is what connects salary and cash account. If you go to the cash account like this, you will see this salary written. That is why it is here. If you go to salary account, you see this particular transaction. So the interconnectivity between these two accounts is what we call the ledger account. So when you are asked to prepare the ledger, what you need to prepare a reliable and a good ledger account is the double entry principle. Let's quickly look at the second transaction. We are going to apply this principle on this second transaction as well. We are going to look at it. They said bought goods worth 1,000 naira cash. I've explained this earlier. First of all, the first thing is the two accounts involved. They are going to be purchase and cash. And then you ask me, sir, why is it purchase? Why not goods? Some students will say goods and what? Cash. There is no account called goods account. Let me say that again. There is no account called goods account because it's very ambiguous. When you say goods account, what kind of goods? You have to specify. If the goods is not specified, then you categorize it as purchase. But if the goods is specified, mention the goods. Assuming I said bought motor vehicle. If it was motor vehicle that is here, you cannot say purchase. You have to specify that it's motor vehicle. So here, the two accounts involved, they are what? Purchase and what? Cash. Then the second thing we said states the receiving and the giving. I told you earlier that purchase is always the receiver. So you say receiver is what? Purchase. While the giver is what? Cash. And then the next one is we say we should note the effect of the transaction. Don't forget that you receive to increase and then you give to decrease. So you simply come here, increase in purchase and the what? Decrease in what? Cash. And then the fourth one is what? Take the necessary action. What is the action? Debit the receiver and what? Credit the giver. So you put your double, your capital D and small letter R, which is debit, purchase, and then credit what? Cash. You have completed it. That's how to go about it. And then the last one is sold goods, 40,000 naira cash. First of all, note the two accounts. This sold here, sold goods. There is nothing like sold goods account. Students will say, okay, sold goods and cash. No, it is called sales. Why? Because the goods that is sold out is not specified. They did not point out the goods that we actually sold out. So because it's not specified, we are going to say sales. So you said the two accounts involved, they are what? Sales and what? Cash. And then the second one is that who is receiving and who is what? Giving. Whenever you sell and the sale is not on credit, money is coming. So at this point, cash is going to receive money. So in this case, we said that the receiver right now is what? Cash. And then the giver, who gave cash this money? Sales. And then the third one is, we said, note the effect. Remember, don't forget our slogan. You give to decrease and then you receive to increase. So whoever receives must increase and whoever gives must what? Decrease. So looking at it, you see that the receiver is cash, while the giver is what? Sales. So the next thing you are going to do now is you are going to note the effect. Increase. Who received cash in what? Cash. And then what? Decrease in sales. And then the last one is what? Take action. What is the action? Debit the receiver and what? Credit the giver. So your DR, who is the receiver here? Cash. Debit cash. And then your CR is what? Sales, and credit what? Sales. That's how to go about this. So if you look at it critically, you will see that double entry principle is a very simple principle. But students find it difficult to understand because they refuse to follow the procedures or the processes that are involved. Now, we are going to go to our exam guide to take some more examples that will further explain what we have done so far. I want to believe that at this point, we've been able to explain what double entry principle is. We have been able to explain the summary of what debit and credit entering is. We've been able to explain the procedures, and then we've been able to do some illustrations how we can apply this. So very quickly, we are going to take some questions from our exam guide. Now, when you click on your exam guide, you will have what is already showing on the screen. And then because financial accounting is our subject of interest, you see that financial account is already clicked there. And then you go to the year. You have different years of, the exam, the WAEC we are looking at. But for the sake of this lesson, random is actually chosen because it's going to give us all the questions that is related to what we are doing. Meanwhile, we recommend that you can choose any year of your choice. And then once you do that, the interest, the topics of interest is the double entry principle. You go straight to your get started, and all the possible questions that you need will just pop up. Now, the first one says, the accounting principle of double entry states that A, assets must be equal to capital plus liabilities, debit the giver and credit the receiver. Debit entries increases liabilities while credit entries increases assets. Every debit entry must have a corresponding credit entry. Now, if you look at option B and option D, if you are in a hurry, you will think that both of them are the same. But let us critically look at it. Now, they said debit the giver and credit the receiver, which is the direct opposite of what we have explained so far. We have said that you debit the receiver and credit the giver. So I recommend strongly that students should be very, very objective when it comes to objective questions. You shouldn't be in a hurry to pick any option, because in accounting, transactions can be similar. The examiner can just form a transaction and change maybe a terminology to check your strength on that particular topic. In this case, it cannot be option B, but it will be what? Option D, which states that every debit entry must have a corresponding credit entry. All right, let's look at question 2. They said that Kadiri paid his debt to Suleiman by check. The accounting entries in Kadiri's books are, look at this, Kadiri paid his debt to Suleiman by check. Now, I want to explain something. In transaction, we don't keep record of people we have settled. No, we don't do that. We only keep record of people we have not settled and people that have not settled us. So if I go to the market with 5,000 naira to buy a rubber of gari, that 5,000 naira I'm taking to the market to buy rubber of gari, if I pay for that rubber of gari, there will be no need for me to come to my account and say 5,000, then you open a gari account. No. But if for any reason I go to that market and buy that bucket of gari without making payment, there is need for me to keep record. Why? Because I will need to remember that I need to pay that person. So if you look at this transaction now, Kadiri paid his debt. Kadiri was owing Suleiman and he decided to pay. So he paid his debt by check. At that point, already Suleiman has been written in Kadiri's book as a creditor. So now that Kadiri has paid Suleiman, that debt is written off. So what Kadiri need to do, Kadiri does not have any transaction with Suleiman again. The two accounts that will be affected is Kadiri's account and what? Car and bank account. That is it. So I said the first thing you should identify the what? The two accounts that are involved. The two accounts that are involved in this case, number one is what? Kadiri. Then you ask yourself, Kadiri and check. Anywhere you see check is, you know that is bank, because bank is the only financial institution licensed to receive an issued check. So anywhere you see check in a transaction, it depicts or represents bank. So the first thing I said, the first step is identify the two accounts. In this transaction, the two accounts, they are what? Kadiri and bank. Now the second thing is that in between Kadiri and bank, who receives and who gives? Now you know that Kadiri is the one that is making the what? The payment. Kadiri is the one that is making the payment. But you should also understand that if Kadiri is making the payment, he is the one that is receiving the benefit of making the payment. Kadiri is the one receiving the benefit. But there's something I want to spell out. I want to say that if Kadiri is actually making this payment to Suleiman, like I said before, Suleiman is not supposed to be reflecting anywhere around this transaction, because Suleiman is somebody that has been paid. But you should not forget that Suleiman has already been written in Kadiri's book. Because Suleiman was a former creditor, we are going to replace Kadiri with Suleiman. I think that's the right thing. We are going to replace Suleiman. We are going to replace Kadiri with Suleiman. Why are we replacing Kadiri with Suleiman? Because Suleiman has already been written in the book as a credit, somebody we are owing. So we cannot just pay him and then we will not do anything to his account. So at this point, it's going to be what? Suleiman and what? Bank. That is going to be the account. It's going to be what? Suleiman and bank. So now we said we receive to increase and then we give to decrease. So now, who is receiving between Suleiman and bank? You know that the receiver now is what? Suleiman. And then the giver is what? Bank. Now the third one is the effect of the transaction. What is the effect? Remember we said we receive to increase and then we decrease, we give to what? Decrease. Suleiman has received because Suleiman is the one we are paying the money to. So we said increase in Suleiman. I know this may violate maybe English. So there's nothing like English in Suleiman. What we are trying to say is that we are trying to explain that because Suleiman is the one receiving, that the cash with him will increase. So, but this is accounting we are doing. So we said increase in Suleiman and decrease in what? In bank. And then the fourth one is take action. What are we going to do? Debit the receiver, which is Suleiman, and then credit the giver, which is what? Bank. So let's look at our options. Option A, bank account. Say should debit bank account and credit debtor's account. No. Suleiman's account should debit Suleiman's account and credit bank account. Debit bank account and credit Suleiman's account. Debit Suleiman's account and credit cash account. Look at option C, option B, and option D. You see, students should not be in a hurry. If you see now, you see cash there. This transaction was actually carried out on check. So it cannot be option D because that one is cash. So the answer is going to be debit Suleiman's account and credit bank account. So the option there, the answer there is option B. Suleiman, debit Suleiman's account and credit bank account. Let's take another question. Okay, they said goods returned to supplier is recorded in the book as goods returned to supplier. When you return goods to supplier, what happened? Look at these two, the transaction there. Anyways, we are going to skip this because this is return invoice day book and it's going to distract our topic. I just want us to limit our transactions on what we are doing in this lesson. Now, the principle of double entry bookkeeping states that we have done something similar to this. Debit entry must have a corresponding credit entry. That's the answer. Every debit entry must have a corresponding credit and entry. Now, let's look at the final question. They said, which of the following is not correct? Which of the following is not correct? Credit sales are entered on the debit side of the customer's personal account. The debit side of the personal, that's correct. Credit purchase are entered on the debit side of the supplier's personal account. Return outwards are entered on the debit side of the supplier's account. Return inwards are entered on the credit side of the customer's personal account. So the ones that is not correct here is B. Credit purchases are entered on the debit side of the supplier's account. The supplier's personal account is an account that deals with goods that goes out of the supplier's shop. So it must be what? Credited. What will be on the debit side? They are just cash received from the customers. So why the transactions on credit will be on the credit side is because he is giving something out. And then whatever he receives from the customers will be what? Debited. So the answer there is B. All right, so far we've explained what the double entry principle is. We have stated how to go to apply the principle, and we have given a summary of what a debit entry and a credit entry is. And then we have looked at some related questions from our exam guide. I recommend strongly that students should not fail to always go back to the exam guide to see how they will be able to solve as many questions as possible as it relates to the topic under review.